Hello, everybody. Hello, and welcome to Private Equity Rundown. I am Bill, the company's expert. Thank you for joining me today. A bit of a late start today, but that's just the nature of things, I guess. But it's okay because it's Friday and TGIF. So hopefully you're having a good Friday. This is the weekly live stream where I talk about private equity. And it's a little bit of an experiment still. It's in the experimental stages, as we'll say. But this is episode number 10. This is episode number 9. Episode 9. You see? I'm on the ball. The title of this episode is called Target Acquisition. So we were talking last week how there's 7 major stages of private equity, okay? And what we're going to do is we're going to go through the 7 stages in the next 7 episodes. So this is the first stage, 1 of 7, and it's the first thing you do in the private equity process. It's target acquisition. So that means that you're going to be looking for a target, which is namely a company to buy, right? And this is the criteria that people use to determine what might be a good company, a good target, which to acquire. And in order to talk about this, we're going to talk a little bit about the structure of a private equity company, what the various people do, and some of the methods where typically this transpires. So how they go about acquiring a target, okay? That's going to be basically what we cover in this episode. And then we'll open it up to questions because this is, after all, a Q&A. I'll see if I can answer your questions. Now, last week, somebody did ask a question. I got a comment, actually, on the video, and somebody said, this was Dmitry Prukkuski, 5250, says, I'm always looking forward to the new episode of the series. Could you pay special attention to valuing high-risk assets like biotech stock on the valuation episode? So that will be in 2 episodes' time. So we'll get into that there, where we talk about, basics of valuation like discounted cash flow and stuff like that, and the methods that they use specifically to look at this stuff. So we will get to that on the 3rd episode, but I did see your comment and I've recorded that. As always, special shout out goes out to my YouTube channel members. You guys are awesome. If you join my channel, there are privileges involved in membership. So special thanks to you guys. Also my Patreons and my super thanks donors. You guys are awesome too. You're all awesome. And my participants, to you for being here. Thank you very much. I see there's 12 people here. Okay, without any further ado, let's launch into this. Okay, so target, God, I got to stop saying target. Target acquisition. Target. Okay, where to start here? I have sort of some notes here, but they're all kind of jumbled up. Let's start out with a couple of things here. Probably, you know what? I'm just going to go right for the jugular here. Let's just jump into the criteria, okay? I'll introduce this, and then we'll sort of set it up and talk about it in more detail. Okay, so when you're looking for companies to buy, how do you determine if a company, a target, and I'm going to use the word target going forward. I'm not going to say company. That's implied. If a target firm is worth pursuing, that means you want to actually acquire it, okay, in some way, shape, or form. How do you determine if it's suitable? Well, there's several big things you can look for. Here is a list of the big things. First of all, growth potential. The point of acquiring a company is so that you can almost do a turnaround. The business usually will not be in distress, but the idea is that you're going to take it and you're going to improve it in some way, and then you're going to sell it. That's the whole point of this. So there has to be some growth potential. If a target is like doing everything perfectly and knocking it out of the park in every area, that might not be the greatest potential target to acquire, because you won't be able to do much with it. So presumably you'll be buying it for such a high price that, you'll be selling it for essentially that price, and therefore there's not going to really be too much of a profit, right? So you're looking for something that has growth potential. So this is where we look at the economics. How do you determine growth potential? You're going to be looking at a variety of different things. You're going to be looking at the internals of the firm, what they're doing, how efficient are they. You're going to be looking external to the firm. You're going to be looking at the industry at large. What's going on in the industry? Okay, are there trends? Are there other things going on? Is there going to be a forecast for an increase in demand, so therefore that the company can grow to fill the demand, as opposed to a decline in demand, right? So you're going to be looking internally, you're going to be looking externally. It's all about economics, microeconomics and macroeconomics. You're also going to be looking for a target that's not too large, right? That's something that's very important because you want something that can grow, and therefore it can't be big and bloated. It should be relatively small, relatively streamlined for what it's doing. So the idea is that you could then ramp it up, okay? You're going to be looking for something that's in a relevant geographic region, okay? If you have a target that's sprawled across different countries, different regions, different legal jurisdictions, there could be a lot of complications with doing that. So it may not be worth the headache, essentially, to get into that, right? So you're looking at something that's fairly self-contained and usually limited to your geographic region. Okay, so that's a big factor. Obviously, you're going to be looking at the financials. Okay, they're interested primarily in things that have strong financials. So it's profitable, it's relatively efficient, but that is not actually the be-all, end-all, depending on the situation. So typically, you're looking for something that's strong. You're not really in the business of doing a turnaround from a technical sense. That's my understanding. In private equity, they leave turnarounds to other types of acquisitions, okay, not necessarily private equity. They're looking at things that are working okay, that they can ramp up, okay? The management team. This is a bit more where the company can come in and tweak things. Okay, they're looking for a management team that's relatively strong, but in a lot of these private equity deals, what typically happens is that the private equity firm will bring in their own management team or elements of a new management team. Okay, one of the big the things that we see in private equity is that the private equity firm, the PE firm, will come in, they'll take over the target, they will put their own key management employees in place, okay? And these will be people with skill sets that know how to take that target company to the next stage. They'll be able to ramp it up. Perhaps, a typical scenario is when the target has been founded by an entrepreneur, and the entrepreneur has grown the business from nothing to being a certain size, but the entrepreneur doesn't necessarily have the expertise to ramp up that business to take it to the next stage. So that's where a private equity firm will put their own management team in place that has the expertise in how to do that, how to take it from this stage to that stage. They have experience doing that, they know how to do it, and that allows the PE firm to add value to the company, whereas the original owner / entrepreneur couldn't. Okay? So going up scale. Another big factor that a PE firm will look at is the exit route. Okay? The whole point of this is that eventually the PE firm will divest the business, they will exit, they will sell it, and that's very important. Now, if nobody's buying those types of businesses, maybe for whatever reason, those businesses are not really in high demand. Maybe there's fears around the future of those types of businesses, things like this. That will obviously be very important. That's going to really color whether this target is a good target or not. And then other things like the reputation of the business in the industry, that kind of thing. Those will all, like those type of external factors, that's going to be looked at too. Okay, so these are the types of things that are examined, okay, when you're assessing targets. Now, what I wanted to do was talk a little bit about the other things that are sort of ancillary to this to help understand why this is done or how this is done. So let's talk about that. So I'm not sure if I actually covered this yet in this series, but I'm going to cover it now for sure. A PE firm, private equity firm, is made up of primarily GPs, general partners. Okay, these are the people that essentially are running the private equity firm. They're called general partners. And what they do is they ultimately have the final say on decisions like what targets are acquired. Okay, so they may have teams that, are resources that do a lot of the grunt work, but ultimately the general partners are the ones that decide what happens if a firm is acquired or not. Okay, now the general partners are responsible. They could be investors, and they usually, as I understand it, will usually be investors. Typically, they are investors also in what they're doing. But unlike a sort of regular investor, these people will have responsibility, liability beyond what they invest. So you could take them to court, you could sue them, like all this kind of stuff if something goes wrong. They're ultimately responsible for what the company is doing. Now, this is different from LPs, limited partners. So if you're a high net worth individual and you want to do some investing in private equity, you would become a limited partner with a private equity company, a private equity firm. And you don't actively manage anything. All you do is you sort of contribute to a PE fund. You input your invested money. It goes into the fund, and then that fund is invested by the general partners when they purchase a company and manage the company. Okay? So that's the difference between LPs, limited partners, which are just investors that want to invest their money, so they go to the PE company, and the GPs, general partners, who run the private equity firm. Okay? That's how this stuff is set up. Okay? So typically what we see is the GPs, general partners, the people that run private equity firms, they come from usually a sort of banking background. They'll have education, certainly in finance and maybe in business and M&A, focusing in M&A, mergers and acquisitions, this kind of thing, right? They may have a career in investment banking, this kind of thing. So that's usually the type of people they are. Now, the big question that you might be wondering is, if these people are responsible and they're primarily bankers and they're about to buy a business, and the business is in a certain industry like healthcare or industry like oil and gas or energy, something like that. What the hell does a banker know about, a small energy company or a small medical devices company? How can they look at that company and see, does this make sense to buy? Is this company run efficiently? Is it inefficient? Is there growth potential in this industry? Is there not? What's the reputation of this company? What's the future of this particular type of product that this medical devices company is doing? What would a banker know about any of that? And the answer is very little, right? So the question arises, how do private equity firms, how are they able to make a intelligent decision on whether one firm is a good target or not, right? Or maybe another firm is a better target. And what they typically do, the way they do this, is that the general partners, because usually they come from a banking background and not an industry-specific background, they will usually assemble a team of advisors together who come from that particular industry, that have good reputations, that are well known in that industry, and they will develop these relationships over several years, so they get to trust this person's advice, get to corroborate it, and really verify that this person knows what they're talking about and they are indeed an authority on that industry. And then they're in a position to take advice from this team of advisors, right? So that's usually how this works. So I think in most of these deals, they have, they employ professional services like chartered business valuators and people like this, but they also will consult with, people that are sort of retired executive managers of similar companies and things like this that will consult for them so that, they can make these kinds of very industry-specific determinations to determine if the target makes sense or not. Okay. Now, let's just step back for a second. So a typical private equity company, in my sort of what I've seen or what I've heard about, just in my sort of world, a typical medium-sized private equity firm, and I'm in Canada here, so I'm imagine this would vary around the world, but is approximately, like, there's different ways of measuring it. It's about 25 to 50 employees. So you could think of it as like a sort of very large law office, okay, about that size, okay? For those amount of people, they could probably manage a total value of companies that's between $500 million and about $2 billion, okay? So that's assets under management. So the value of the companies in their portfolio is between $500 million to about $2 billion, and this is good. This is like essentially the sale price, the total valuation of the firm, and the average, probably around the average price of each target or each member company is approximately $100 million. So that's kind of the scales we're talking about here. So all of that is run by between 25 and 50 employees. Maybe 5 of those will be general partners. So they're the ones that are essentially running the show, that have final responsibility for this. Now, in that situation, okay, you're going to be able to have a small team that will help you with target acquisition. Okay, it's not all just personally done by the general partners. You'll have a few people to assist the general partners in doing that. Okay, so there's a chance they may have a target origination team. Okay, and the target origination team, there's, I don't know, a handful of employees that work on that team, and these people are the closest thing you're going to get to like the sort of sales arm of the company. It's not very big, but because you have multiple people and you have sort of some worker level people here, you can afford to do certain things. Now, how does a private equity firm typically find out about potential targets? Okay, that's a big question. Like, if you're in this game, how do you know that a company is up for grabs, or they're open? The management team and the owners are open to being acquired. Okay, there's a couple of different sort of vectors, I guess you could call it, that you would determine this. One would be the most sort of harmless kind of hands-off way this would happen, which is, let's pretend that you had a business that was owned by an individual, and they're wanting to retire, they're old, they've built up this business, they've run it their whole life, but they've decided that for whatever reason, it's not going to stay in their family, they're going to divest it, they're going to sell their business, okay? And they may just approach the PE firm, the private equity firm, and say, look, I'm looking to sell, let me know if you'll take any of that action, and you give me a good price, right? So this is a type of inbound opportunity. The private equity firm isn't actually going out there and promoting itself or putting out feelers. It's just sitting there saying, this is what we do, and then targets are coming to it. Okay, so that is one vector. Just like you might sell a small business and you go to a small business broker, if you're a little more upscale, you might not go to a small business broker, you'll go to a PE firm and say, I'm looking to sell. Okay. So those are inbound opportunities when, companies seek to sell, right? Now, if you have, like I said earlier, if you have a target origination team, these are workers in-house in the private equity firm that are going to be going out and trying to drum up business, trying to discover targets, right? And so they may do a couple of different vectors to try and do this. One would be to go to industry trade shows, just see who's in the industry, try and build some relationships with people in the business. And something, of course, I forgot to mention is that usually private equity firms, they try and specialize in one or two industries. That's kind of usually how this works. You'll have expertise in one or two industries. Maybe if it's two industries or two or more, they'll be very closely related industries, right? And so you focus on that. So you could go to trade shows. You could meet all the players, all the people in that industry, get to know the individuals involved, get to know the companies involved, and sort of actively seek out targets. Okay. Another thing that you might do if you're on the target origination team is what you can do is you can do a sort of targeted outreach to companies, a very proactive kind of thing, just showing a lot of initiative, and reach out and say, would you be interested in selling? That kind of thing. Or we'd at least like to open a dialogue. We'd like to investigate if you're open to it. We could see what kind of deal we could give you and what would be involved. Are you open to that? That kind of thing. Okay. So, that's sort of direct outreach. You could also, the big thing, of course, is you're going to be doing a lot of networking, okay, within the business community of your city or your geographic region. You're going to be doing a lot of networking with the people that are sort of the players that are in that industry. So this is the kind of stuff where the target origination team, that's what they deal with, okay? So you could have employees doing this kind of thing and bringing ideas to the general partners, and then the general partners, basically, there is no as far as I can tell, there is no standard, paint by numbers procedure, because these types of deals are not a dime a dozen, and therefore the GPs are micromanaging each deal. They're personally investigating each deal, and they're hands-on involved in them. And, they do it however they see fit doing it. There's no sort of like standard process. Every company is unique, and because these don't happen too often, you have to really micromanage every one of these deals. So that's kind of how that works. So that's when you get to what we were talking about, what we started off this stream with, talking about the target identify, if you see what I'm saying, where we started talking about the target identification criteria, all the specific things they look at, things like growth potential, the size of the business, the geographic region, the financials, the management team, exit routes, and the reputation that business has in that industry. Okay, so we looked at that. Now, my understanding is that you can't really make generalizations because, like I said, these deals are very customized. You can make generalizations like and say things like, well, it has to have very strong fundamentals. It has to have, profits in this range, this multiple of its, asset value or something. You can't really do stuff like that because you're looking at each case separately. And it also depends very highly on the strategy of the PE firm. Okay, so some PE firms will focus more on almost like turnaround type situations where you're really targeting companies that are in distress. So you can get them for cheap, but then you have to really come in and change them quite a bit to turn a profit. Other PE firms are a bit more conservative. They're not really looking for distressed targets. They're looking for very steady, profitable targets. And they're not going to come in and mess with them too much. They're going to try and ramp them up if they can, or provide new leadership that can take them to the next level. But they're not going to be sort of gutting the company and messing with it and rethinking it and all this kind of thing. So it really depends. Like the way I guess I would put it is that the biggest factor in what you look at in the target acquisition stage is going to be determined by the strategy of the PE firm, what they specialize in, what their area of expertise is, and then beyond that, the industry in which they specialize in. So the industry is going to be predetermined and their strategy is going to be predetermined. And that's going to govern specifically what you look at in determining a good or a bad target. Okay, it's not just a simple matter of looking at the financials. Sometimes you might all but ignore the financials and look at the competitive position. You look at its reputation within the industry, things like this, right? Its growth potential. You're also going to be taking into account the life cycle of the industry and the life cycle of the company. So for the industry, it could be there's an industry life cycle. I don't know if everybody's familiar with this. I think everybody is, where, it starts off in that sort of enthusiast market. It's kind of leading edge, bleeding edge kind of enthusiast market. And then it settles into a sort of growth phase, right? Where it starts to become mainstream. It starts to catch on and it's a trend and it just ramps up. And then you get to maturity. You don't get that tremendous growth, but, it's steady, it's stable. Everybody's familiar with it. It's doing well. And then finally you go into the decline phase where people are moving away from it, right? Things like fax machines and VCRs, we saw the decline phase, right? So at each of these phases or stages of the life cycle, it's going to be a completely different dynamic. What the expectations are, and even how you run the business is going to be quite a bit different. Okay, so that's like an entire industry. And then within the industry, you're going to look at the company. It could be a new company. Maybe they're just sort of in the startup phase. They're tremendously profitable, but it's very slipshod. It's very haphazard. There's not a lot of formal structure to it. There's a lot of chaos. It could be in the growth phase. It could be in the maturity phase where, you've settled in, you've got a lot of business systems in place, right? And so on. So you're also going to be considering this stuff too. So there's a lot of things you're going to be looking at, but the primary factors, I would say that the key takeaway here is that you're going to be pegging it to only one or two industries usually. In smaller markets, PE firms might have to have a broader focus because there's less players in each industry. For example, I'm in a city called Winnipeg in the middle of Canada. It's got less than 1 million people in it. So this would be a place where you have, the PE firms would have a broader focus because there's less players in every industry, right? If you're in a place like New York City, you could probably have a much narrower focus and focus in on one industry or just a certain subset of an industry, right? Okay, so the first criteria is what industry does the PE firm focusing? Second is what is their strategy? What's their area of expertise? Do they do turnarounds? Do they do some specific thing that ramps up the business? That's the primary factor. And then you look at all these other criteria and then make a decision based on what you find. So that's kind of what I'd say about that. I think that's pretty much covers what I had written here. I'm going to open it up for questions. Always remember that if you want to go deeper into business with me, check out that course, my $100 MBA course. It's actually a program where you get the same learning as you would in a brick and mortar MBA program because you're learning the same material. And it's a self-study program. You could do it at your own pace, on your own schedule, and to the degree in which you're interested. So if you want to just skim the material, that's fine. If you want to go really in depth, you certainly can. If you want to mix and match, maybe you're not interested that much in accounting, you just want to skim it, but you want to go really in depth to something like marketing, or innovation, then you can, right? So that's the beauty of that. That's why I created it. And definitely for some people, that fills a need. So check that out. There is a link in the description box of this live stream if you're interested in that. Okay, I'd like to open it up to questions. If anyone does have any questions, I see there's 17 people here. If you do have any questions, if you're a subscriber to my channel, get in the chat. And I'll wait a couple of minutes to see if anyone has anything. And I'll be happy to do my best to answer your question related to private equity or business in general, I suppose. But yeah, it's an interesting thing. Like I've mentioned a couple of times, private equity firms, they're known for doing a few sort of standard things. One of the things that they'll do is they will usually leverage the business right up, like with financial leverage. They'll take out all kinds of debt and just cram your books with debt because they can. They usually acquire the business in some kind of leverage buyout. So it's financed mainly through debt. And then once they control the business, they will get the business to take on a ton of debt. And that just maximizes the amount of money you make versus the amount of money you put in. That maximizes it. So that's a well-known thing. And I'm going to get into that in a future episode when we get to that point. That's more my sort of expertise. Not the taking on debt thing, but what to do with the business once you've got it, how to improve it, how to do a turnaround, how to increase your efficiency, how to maximize your profitability on the revenue and the cost side. So that's more my core competency. So it'll be fun talking about that when we get there eventually in a few episodes. Okay, I don't see a ton of questions, so that's not a problem. I want to say hello to Syed. Syed says good afternoon. Good afternoon, Syed. That's probably good for this week. Check out my course. I will be back same time next week with the next episode of Private Equity Rundown, which we will be covering stage 2 of the PE process, which is due diligence. So the first step was to try and find a target. The second step is to do your due diligence on that target. Make sure that you're getting the full picture, right? Before you take on something that could be bad, or it could have hidden liabilities or hidden costs. You don't know. So that's what we're going to cover next time. Until then, have yourselves a great weekend. I will be live again on this channel in like 15 minutes talking about job search. So if you're interested in that, join me in 15 minutes live. We'll be doing a Q&A for over an hour. So there you go. Thanks, everyone. You guys are awesome. Take care. I'll see you soon.